determined in accordance with IS 41. But even before we do that, it is important for me to mention that these things are living animals and also living crops. They should be recognized as assets in what? In the statement of financial position. They should be recognized as an asset in the statement of financial position. But still, according to this particular standard, for them to be recognized as an asset here, they must meet various conditions. They must meet various what? Conditions. One of the conditions is that the fair value, or basically the cost, the fair value of the cost of this particular biological assets, the fair value or the cost of the biological assets, assets should be measured reliably. Should be, or actually we say can be measured reliably. Can be measured reliably. Can be measured reliably. So what that means is that if an entity can be able to measure, can be able to determine the fair value or even the cost of those particular biological assets reliably, then in this case, the company should recognize them as an asset in the statement of financial position. Otherwise, if the company cannot be able to determine the fair value, cannot be able to determine the cost of a biological asset, then it should not be recognized within the statement of financial position as what? As an asset. They should only be recognized here as an asset if their fair value, or basically their cost, can be measured reliably. Can be measured what? Reliably. Number two, they should also be recognized as an asset if the entity controls such assets. If the entities control such what? Asset. And basically in this case, by the asset controlling the asset, it basically means that the asset here, not the asset, rather, the entity is in a position to direct. Is in a position to direct the use of the asset. Is in a position to direct the use of the asset. So meaning that in this case, if you are in a position to direct how an asset will be used, then in that case, we say that you are in control of that asset. You can direct how the asset will be used. So therefore, this biological asset, on the other hand, we are saying they should be recognized as an asset in the statement of financial position if the entity controls. Not to own, but rather do what? Controls the asset. And number three, they should also be recognized as an asset if it is probable, that future economic benefits will flow into the entity, from the financial, from the biological assets, from the biological what? Asset. It is probable that future economic benefits will flow into the entity asset. What do you mean by that? Future economic benefits. It basically means that it is probable that future cash flows will be generated from these biological assets. If, for example, you are a dairy farmer and therefore you own a number of dairy cows, so in future, automatically you're likely to sell them. Maybe once those dairy cows get old, maybe you can sell them, maybe you can sell them for them to be slaughtered and then be sold in form of what? In form of, or basically be sold as meat. So it is basically probable that they will generate some cash flows once they are sold in what? In the future. So therefore, if these three conditions are met, or a biological asset meets these three conditions, its cost or its fair value can be measured reliably, the entity control the asset, and it is probable that they will generate some future cash flows, then we are saying they should be recognized in what? In the statement of financial position of the entity as an asset. As what? As an asset. Then from there, I want us to look on how do we determine the value? How do we determine the value of biological asset in accordance with IS 41? If today you are a dairy farmer and maybe you have bought a number of dairy cows, how do you determine value, because we are saying these are asset to you. When preparing the balance sheet at the end of the year, you should recognize them there as asset, but you should record them there at which value. So according to this standard, that is the International Accounting Standard number 41. International Accounting Standard number 41, biological assets are initially and subsequently, I'll be able to explain what you mean by that, are initially and subsequently measured at fair value less cost to sell. Less cost to sell. The fair value less cost to sell. What do you mean by this? That they are initially. Initially basically means that once you have acquired a biological asset, assuming you are a dairy farmer, you have bought a number of dairy cows. So a question may arise. These particular dairy cows, you should record them in your books of account at which value. We are saying record them in your books of account, at their fair value. The fair value in this case, who can tell us the other name for this? When talk about the fair value of an asset, what is the other name for this? Who can be able to tell us here? The fair value of an asset. There is another name for this. The fair value. The fair value is also known as what? Who can tell us here? Who can tell us? Juliet, Lucy, Felix. What is the other name for this? The fair value. The fair value who can tell us there is another name for this. Aaron. Yes, that is very much correct. It is the market price. It is the current market price. So this is the current market price. The current market what? Price. The current market price of an asset is the same with the fair value. So we are saying that if today you have bought some biological assets, you have bought some dairy cows, then you record them in your books of account at their fair value, their current market value. But in this case, you have to less the cost to sell. The cost to sell basically is the cost which you can incur if you decide to sell those particular cows. In most of the cases, you can be told that if you want to sell those particular dairy cows, you can only take them to the market, maybe in an open market where the buyers will come in. And because that is
movement along the supply curve, what we call movement. We call it the movement along the supply curve. Movement along the supply curve. Stroke what we call changes. We call it changes in what we call in quantity supplied. So changes in what we call quantity supplied. So movement along the supply curve, stroke what we call changes in what we call quantity supplied. So the changes in quantity supplied. So the other name of movement along the supply curve is changes in quantity supplied. So number one, at the back of the mind, I want you to remember that when you talk about movement along the supply curve, is caused by changes in price only. It basically implies that other factors are held constant, but what causes the movement along the supply curve, so stock changes in quantity supplied, is what we call price of the commodity. So we can have the diagram, then we illustrate. So on this diagram, on the y-axis, we have the price. This is the supply curve. On the y-axis is quantity. On the y-axis is definitely quantity. So we can have price P1, and then we have P1, this is Q1, then P2, then this should be what we call Q2. That should be Q2. So we can have this when price increases, and when price decreases, we're not by that. So quantity increasing, this, then when you have quantity reducing, that. So then when you proceed, we have a point. We have point X, Y. When it's moving, so look up to. So the movement along X, Y and Y, X is what you call the movement along X, Y, and Y, X is what you call movement along the supply curve together. The movement along X, Y, and Y, X is what you call the movement along the supply curve together, is what you call the movement along the supply curve. We respond with a yes if we are together. We respond with a yes if we are together. We respond with a yes if we are together. So perfect if we are together. Thank you. All right. So we can denote this and talk about it when we say at low price P1, we can say at, we just give it here, at low, we say at low price P1, the quantity, we can know the quantity supplied is low at Q1. So at price 1, the quantity supplied is very low at Q1. Are you able to see that? The quantity supplied is low at Q1. And you say when the price is increased, say when what you call the price is increased, we say from P1 to P2. So when the price is basically increased from P1 to P2, what happens? When the price is increased from P1 to P2, what happens? We see that the quantity supplied is now going to increase from Q1 to Q2. To say that the quantity supplied, we say will increase, we say from what we call Q1 to Q2. So the quantity supplied definitely will increase from Q1 to Q2. While that is happening, are you able to see? When you increase it, what is going to happen along the supply curve? We have it moving from X to Y. Are you able to see? While that is happening, we have a movement from X to Y when you increase the price. Are we able to see that? Are we able to see that? So we say this causes what we call a movement. We say along what we call the supply curve. Along the supply curve, causes a movement along the supply curve. We say from X to Y. That definitely causes a movement along the supply curve from X to Y. Causes a movement along the supply curve from X to Y. Then we can come here and say, on the other hand, so on the other hand, at P2, we say that the quantity supplied, we say is high at Q2. Are we able to see that? On the other hand, when you're at price P2, you can see that the quantity supplied is very high at Q2. Are we able to see that? The quantity supplied is very high at Q2. Are we able to see that? Perfect. Abdi Nasir is very high at Q2. Then you say when the price is decreased, when the price is decreased, we say from P2 to P1. So when this price is basically decreased, look up from P2 to P1. What happened, Kitao? when the price is decreased from P2 to P1, what happens? When that price is basically decreased from P2 to P1, what happens? When the price is decreased from P2 to P1, what happens? So what happens? The quantity supplied is going to be reduced. So when the price is increased from P2 to P1, comma, we say quantity supplied, what they call the quantity supplied, we say reduces, we say from Q2 to Q1. So the quantity supplied basically reduces from Q2 to Q1. And what does it cost along the supply curve? What does this basically cost along the supply curve? What does it basically cost along the supply curve? We know that for sure, there's a movement along the supply curve now from Y to X. So say this causes a movement, this causes what you call it, a movement along what you call the supply curve, along the supply curve, causes the movement along the supply curve from, we call it from Y to X. That definitely causes a movement along the supply curve from Y to X. Together from Y to X causes a movement along the supply curve from Y to X. Causes a movement along the supply curve from Y to X. Causes a movement along the supply curve from definitely Y to X. From Y to X. Are we able to see that? From Y to X. But at the back of our mind, I did give you something that whenever we talk about movement or changes in quantity supplied, it is basically caused by changes in price only. Other factors are held constant. So I put an NB and say, movement along the supply curve, movement along what we call the supply curve, movement along the supply curve, what we call the movement along the supply curve, is brought about, we call it by changes in price only. Other factors held constant. Is brought about by changes in price, other factors held constant. In economics, what did you say about other factors being held constant? The name is what called ceteris paribus. In economics, we say that ceteris paribus. When you want to say that other factors held constant, we simply say ceteris paribus. Together. Is that understood? If that is understood, we respond with a yes. Perfect. So then we proceed to the next, that is what we call shift in supply, so changes in supply. We move to what we call shift in supply, what we call the shift in supply, what we call shift in supply, shift in supply, what we call shift, we call it shift in supply. So what we call changes, we call it the changes in what we call supply, the changes in supply. So the shift in supply is to what we call the changes in supply, shift in supply, so what we call the changes in supply. At the back of our mind, I want us to remember that whenever we talk about shift in supply, it is brought by other factors other than price. So at the back of your mind, you need to understand that whenever we talk about shift, it is brought by other factors other than price altogether. It is brought by other factors that affect supply other than price. So what are these factors that affect, what are these factors that basically affect supply other than price? What are those factors? What are those factors other than price? What are those factors other than price? Climate, climate, We have the cost of production, we have technology, we have transport and communication, we have issues to do with incidents of strike. But we put a diagram just to denote what you're saying when you talk about shift. So this is what denotes basically shift. So this is the y-axis, this is price, this is quantity, this is quantity. So this is the normal supply. So we have this, we have this, we have that. So this is S1, we can call it S1. This is SO, SO. This is S2, S2. Together, team. So on this, we remember that price is basically constant. Sorry, this is price is constant. If it's price, price is constant. But price does not cause changes in this. So we can put one of the factors called climate. We call it climate. Together, we call that factor climate. We respond with a yes if we are together. If we are together, we respond with a yes. So we call that factor climate. And I want you to enjoy. I want you to seriously enjoy economics. So when I look at this, I'll get this is quantity. This is quantity. So I want us to denote a number of things. So that this is the equilibrium quantity. So this will be QO. We'll give it as QO. This is Q2. This is Q1. Together. Are we together? Together. Together. Perfect. So when you look at this, we know that SO, when you have SO to S2, S2, this is the right word. Right word in supply curve. We call it the rightward shift in the supply curve. We call it the rightward shift in the supply curve. We call it the rightward shift in supply curve. So the downward shift in supply curve is also known as the downward shift. So when you see the word downward shift, shift in what you call in supply curve. Downward shift in what you call the supply curve. The downward shift in what you call the supply curve. The downward shift in what you call the supply curve together. On the other hand, when you talk about SO, so this is when you have SO, SO to S1, S1. So when you talk about SO, SO to S1, S1, we call this one the leftward shift. We call it the leftward shift in what we call in supply curve. The leftward shift in supply curve. So the other name in an examination, if Abdi Nasir, Mary, and Kitawa gets it, the other name is upward shift in supply curve. We also call it the upward shift in supply curve. We call it the upward shift in supply curve. Denoted, noted, upward shift in supply curve. So we talked about factor. We say that under this scenario, the price is basically remaining constant, and the shift in supply is basically caused by other factors other than the price. It is definitely caused by other factors other than the price. So on this, we talked about climate. So we say that if climate, we know that becomes favorable. If the climate basically becomes favorable, quantity supplied, the climate becomes favorable, quantity supplied increases. We know that from QO to Q2. So if the climate basically becomes favorable, we know that the quantity supplied will basically increase from QO to Q2, from QO to Q2, from QO to Q2. This causes, we understand this causes a shift to the right of what you call of the supply curve. This definitely causes a shift to the right of what you call of the supply curve. That will cause what you call a shift to the right of what you call of the supply curve. That will definitely cause what you call a shift to the right of what you call of the supply curve. That will cause what you call a shift to the right of the supply curve. We know that from SOSO to S2 S2. So the other name we know that other name is downward shift of supply curve. The other name is what we call the downward shift of supply curve. That is the other name. The other name is downward shift of supply curve. We call it the downward shift of the supply curve. I hope everybody is at home. So factors that causes the rightward shift of supply curve. What are these factors that will cause a rightward shift of supply curve? At the back of your mind, understand that whenever we have a rightward shift of the supply curve, it basically results into an increase in quantity supplied. So we can talk about factors. We'll talk about factors that causes what you call a rightward shift of supply curve. Rightward shift of supply curve. What are these factors that will cause the supply curve basically to shift to the right? Factors that will cause a rightward shift of supply curve. One of which we understand is what's called favorable. We call it the favorable climate. We call it the favorable climate as one of the first factors, favorable climate. Then we talk about better technology. Better technology, when you have a good technology, better technology as another factor. Then you can talk about reduction in the cost of production, reduction in what you call in the cost of what you call production, reduction in the cost of production as another factor. Then we can talk about favorable government policy, favorable, we call it government policies, and we have it e.g., we have it as reduction in taxes. We have it a favorable policy, one of it is reduction in taxes. Favorable government policy, for example, reduction in taxes. Then you have also good transport and communication. When you have what you call a good transport and communication, that definitely leads to what you call a rightward shift, which results in increase in quantity supplied. Then we can also talk about reduction in incidence of strike, what you call reduction in what you call in the incidence. So what you call the incidence of strike, reduction in the incidence of strike. When there's a reduction in what you call incidence of strike, that basically leads to an increase in quantity supplied. We can also talk about what you call time in the long run. When you talk about time, we understand time that should be the long run. We have time in the long run. In the long run, that should be okay. Together, team, that is the rightward shift. That is from SO to S2. We responded the SCP together. So we can also talk about expectation of a reduction in price. Again, expectation, we can together, team? We respond with a yes. Are we together? If you're together, we respond with a yes. Perfect, Mary. So then we talk about, on the other hand, so we talked about if climate, on the other hand, if climate is unfavorable, on the other hand, if what we call the climate, because if the climate, we say, is unfavorable, if the climate is basically unfavorable, what is supplied? Quantity supplied, we know that will reduce. Quantity supplied definitely will reduce from QO, we have it to Q1. So on the other hand, if you have the climate being unfavorable, we understand that the quantity supplied will definitely decrease from QO to Q1. The quantity supplied, we know for sure, will definitely decrease from QO to Q1. From QO to Q1, this causes shift in supply curve. This causes what we call a shift in the supply curve. A shift in the supply curve? Supply curve to the left, and we call it upward shifting of supply curve. The other name is upward shifting of supply curve. We call it the upward shifting of supply curve. And we know that denoted by SO to S1. So denoted by SO to S1. Denoted by SO to S1. So I want to talk about causes, what we call causes of the leftward shifting of what we call of the supply curve. Factors that causes of the leftward shifting. One we've already been given, we call it unfavorable. We call it unfavorable climate. We call it the unfavorable climate. Number one, then you can talk about obsolete or poor. Poor stroke what you call obsolete technology. When you have a bad technology, it results into reduction in quantity. So then we have the next what we call increase. We call it the increase in the cost of production. Increase in what we call the cost of production. Increase in what we call the cost of production. Then you have what we call unfavorable government policies. For example, i.e., we have it as increase in what we call the taxes. Unfavorable government policy. For example, whenever we have instances of increase in taxes, increase in the taxes, then you have what we can talk about poor transport and communication. What you have as poor transport and communication. For transport and communication, what you call poor transport and communication. What you call the poor transport and communication. Then you have increase in the incidence of strike. What you call as increase in the incidence of what you call strike. Increase in what you call incidence of strike. Then you have expectation of an increase in price. Expectation of what you call of an increase in price. So these are factors that will lead to a shift to the left or upward shifting of the supply curve. Tuko pamoja. If you're together, then you give me a yes. If we are together, then you give me a yes. Perfect. So I want us to go to what we call interrelated. But before we go to interrelated, I say the point, that whenever we talk about shift, it is caused by other factors other than price. So shift in supply are brought about as an NB at the back of your mind, NB. Shift in supply, we know that are brought about. We know that by other factors, by what we call other factors other than are brought about by other factors other than influencing price, influencing supply, influencing supply. We know that other than the price. So other factors influencing price, influencing supply other than price. Other factors that influence supply other than the price. It is caused by other factors that we know that influences supply other than the price. Together, team. We should enjoy what you're doing. So then I want us to proceed. On now what we call interrelated supply. I want us to proceed on what we call interrelated supply. What we call the interrelated supply. Interrelated supply. I want us to go on what we call interrelated supply. Interrelated supply. Call it the interrelated supply. We call it the interrelated supply. So basically on the interrelated supply, we have a number. We have a joint supply, we have a composite supply, and then we have competitive supply. So then we start with the first one. We call it a joint supply. So Kitawe, when you say a joint supply, what do you basically mean by joint supply? As one of the first interrelated supply. So some goods, we know that some goods are produced together. So when you look at some goods are basically produced together. And so we always say that the total supply for such goods is called a joint supply. Some goods are normally produced together. Some goods we know that are normally produced together. Some goods definitely are normally produced together. And say the total supply for such goods, the total supply for such goods, is known as what we call the joint. The total supply for such goods is known as what we call a joint supply. The total supply for such goods is known as what we call a joint supply. The certain goods are basically produced together, and so we understand that the total supply for such goods is basically known as a joint supply. A given example pertaining to joint supply, we can talk about crude oil. Example, crude oil, e.g., crude oil, we know that different oil products, we know that are produced. Different oil products are basically produced. produced. Different oil products, we understand now, are basically produced together. Then the second, we have what's called a composite. We have it as a composite supply. So what is a composite supply? Composite supply. So some goods are what you call substitute of each other. So some goods are substitute of each other. When you talk about coffee and tea, those are substitute of each other. So I'm basically saying for such goods that the total quantity produced is called composite supply. So we know that for some goods are, we understand that some goods are substitute of each other, are substitute of each other. Some goods are definitely substitute of each other. Some goods are substitute of each other. Some goods are substitute of each other. The total quantity supplied, you know that the total quantity supplied, we understand that the total quantity supplied, the total quantity supplied is called the quantity produced, supplied, or produced. We say is called what they call a composite. It's called a composite. We know that it's basically called a composite supply. It's definitely called a composite supply together. That is called a composite supply. It is called a composite supply. Then you have the last one on interrelated. We call it competitive supply. We call it competitive supply. So what is a competitive supply? When you say competitive supply, what do you mean by the word competitive supply? So when you talk about competitive supplying, this refers to the different